Who hasn't heard of Warren Buffett, one of the world's wealthiest people and a regular on Forbes' list of billionaires? Buffett is known for being both a successful businessman and a generous philanthropist. He is well known for being one of the world's most successful investors. This explains why Warren Buffett's investment strategy has become legendary. Buffett follows several key tenets and an investment philosophy that is widely followed around the world. So, what factors contributed to his success? Let's find out. Never jeopardize business quality. While it is relatively simple to say no to overly complicated businesses and industries, identifying high-quality businesses is more difficult. Over the past 50 years, Warren Buffett's investment philosophy has evolved to focus almost entirely on purchasing high-quality companies with promising long-term growth prospects. Some investors might be surprised to learn that the name of the company is derived from one of Buffett's worst investments. Berkshire Hathaway was a textile manufacturing company, and Buffett was enticed to buy it because the price appeared to be low. He believed that if you bought a stock at a low enough price, there would almost always be some unexpected good news that would allow you to unload the position at a reasonable profit, even if the company's long-term performance remained poor. As he has gained more experience, Warren Buffett's stance on cigar butt investing has shifted. Unless you are a liquidator, he believes that buying businesses is a foolish approach. The initial bargain price is unlikely to be a good deal. One problem is solved and replaced by another in a difficult business. As a result, these businesses typically earn low returns, eroding the value of the initial investment over time. It is far better to buy a wonderful company at a reasonable price than a reasonable company at a reasonable price. Unlike some value investors, Buffett believes that buying wonderful companies with better economics and competitive positions is a better strategy. Part of the issue is that while good companies go on sale fairly frequently, great companies rarely do. A company with a good competitive advantage, on the other hand, will most likely continue to make money over time and can bail you out if you pay too much. Unfortunately, that is not always the case with a reliable company, which may falter and never return to or exceed your purchase price. Buffett has also long been a supporter of Bank of America, a national bank with an enviable deposit franchise. With a stake worth more than $32 billion, it is the second largest holding in Berkshire Hathaway's portfolio as of the second quarter of 2022. Do your homework. The good news for investors who are lazier, busier, many experts have already completed the research for you, and it is easily accessible for a small fee. However, if you take Buffett's advice, you should always conduct your own research and never invest in a company you don't understand. A good place to start is by researching a potential company. First, investigate who is in charge of the company, what it promotes, and how it promotes it. Next, do you comprehend the product and believe it has a future in the marketplace? Finally, pose the question: would you rebuild this company from the ground up if given the opportunity? Examine the financial statements of the company, which are usually available on their websites. Look over their financial statements. Are their profit and loss statements, cash flow statements, operating costs, revenue, and expenses in order? Is your net profit up in recent years? Is the company's debt out of control? You should also consider the overall economy and how a company stacks up against its competitors. In a crowded industry, you want to invest in companies that stand out and have room for growth. Finally, stay up to date. When a transaction is completed, your investment in a company does not end. As the economy evolves, so should your portfolio. Above all, feel free to discontinue active investing. I believe that owning the S&P 500 index fund is the best thing most people can do, Buffett said at his 2020 shareholder meeting. People pay a lot of money for useless advice. We simply try to be fearful when others are greedy, and greedy when others are afraid. While some investors believe that investing is primarily concerned with numbers, Buffett believes that investing is primarily concerned with investor behavior. When investors become greedy and drive stock prices skyward, Buffett fears a market crash is imminent. When investors flee the market or a specific stock due to lower prices, Buffett becomes more interested. This is due to the fact that when stocks are less expensive, they do not carry the same level of risk as when they are more expensive. This is how Buffett thinks about avoiding losses. As investors became concerned about COVID, the market fell in early 2020. Despite their fears, some investors jumped into the market, which quickly recovered from its lows. Diversification can be risky. Individual investors benefit the most from diversification when they own 20 to 60 stocks from a variety of industries. Many mutual funds, on the other hand, have hundreds or even thousands of stocks in their portfolio. Warren Buffett is the antithesis of this. In 1960, Buffett's largest position accounted for 35% of his total portfolio. Despite owning several large operating businesses, Apple accounts for roughly 40% of Berkshire Hathaway's equity portfolio today. Warren Buffett believes in his best ideas and understands that great companies are rarely available at reasonable prices in the market. You'll notice that our major equity holdings are few and far between, Warren Buffett said. This is because we make such investments on a long-term basis, weighing the same factors as if we were buying 100% of an operating business. Favorable long-term economic characteristics, competent and honest management, a purchase price that is attractive when measured against the yardstick of value to a private owner, and an industry with which we are familiar and feel competent to judge long-term business characteristics. Finding investments that meet such a standard is difficult, which is one of the reasons for our holdings concentration. We require assistance in locating 100 different securities that meet our investment criteria. We are, however, perfectly content to concentrate our holdings in a much smaller number that we find appealing. When such an opportunity arises, he takes advantage of it. Applications come and go. Put out the buck, not the thimble, when it rains gold. When an investor owns 100 stocks, it is difficult to keep track of current events affecting their companies. Excessive diversification implies that a portfolio will be invested in a number of mediocre companies, diluting the impact of its high-quality stocks. Diversification protects against illiteracy. For those who know what they're doing, it makes no sense. Warren Buffett never lose money, and remember his rule. Buffett's point appears straightforward, but it is deceptively complex. Of course, you want to make money in the market as an investor, but one of the best ways to do so is to avoid losses. When decisions that put your portfolio at risk of loss are eliminated, what remains is more likely to be a profit. Furthermore, when you have more money in your portfolio, your gains can compound even faster. The strategy will have an impact on how you invest. According to Buffett's quote, instead of seeking the greatest possible upside, you should first avoid losses and then consider gains. Unfortunately, that is not the mindset of investors who view the stock market as a game. The casino is now open. According to a Schwab survey, approximately 15% of all current U.S. stock market investors plan to begin investing in 2020. Furthermore, the majority of those who opened their first non-retirement investment account that year were under 45 and earned less than the seasoned investors. Over the last 2 years, approximately 20 million new investors poured their extra cash into the U.S. stock market, promoting narratives that sent the shares of companies like GameStop soaring 100 times in price in a matter of months on Reddit and other online communities. These stock rallies were primarily driven by technical factors, such as a coordinated short squeeze, rather than whether the companies were long-term viable. At his company's April meeting, Buffett stated that indiscriminate buying contributed to Wall Street's becoming a gambling parlor. Technical analysis is useful for short-term trading and market timing, whereas fundamental analysis is useful for long-term investing, which is less susceptible to economic fluctuations. In the long run, equities outperform inflation and recover from downturns by a wide margin. But it's a marathon, not a sprint. Buffett is well known for stating that the holding period of his preferred stock is indefinite. Fundamental analysis doesn't tell investors much about what will happen in the near future, but analysts say fundamental investing is the way to go when the going gets tough. What do you think about Warren Buffett's strategies? Please let us know in the comments section below.